Unit 2.7. Market failure, externalities and common pool or common access resources. Part 3. Public goods, asymmetric information, information failure. 3. Adverse selection distorts the process by which the price and quantity of goods or services are determined, so leads to a suboptimal selection or choice. 4. For example, in the health insurance industry, the people most likely to buy health insurance are those with underlying health issues, such as smokers and drinkers, and people of middle age upwards. 5. The insurance firms naturally increase the price of insurance coverage of this group of highest level of risk to cover their high insurance claims and payouts. However, the adverse selection in this case is likely to cause healthy people to have to pay the same high insurance price as riskier people, making it unaffordable for some of them and to not have the benefit of insurance coverage. 6. Another example would be in the used car market, where the sale of a relatively new car may make buyers suspicious about the reasons for the sale of the car. The limited knowledge or asymmetric information means that potential buyers may think the worst and sense the car will have problems. 7. Buyers may also assume that second-hand cars are of good quality if the price is relatively high, and that cars are of low quality if the price is comparatively low. 8. However, only the car dealer will know the exact quality of the used car and may hide imperfections of the car from potential buyers, causing buyers to buy a lemon. Thus the law, Lemon's Law, created by the government to protect unknowing buyers. Moral hazard. 1. A moral hazard is a situation where a party protected from risk, owing to having superior information, behaves differently than if they were fully exposed to the risk. 2. The individual or firm behaves in a less careful manner, taking unnecessary risks, because they are encouraged to act less carefully or because they believe that their lack of care will not be found out, thus imposing costs on the party that has inferior information. One party knows more about their intended actions than the other party. Thus, moral hazard is the result of asymmetric information in economic transactions. 3. A moral hazard was seen during the global financial crisis sparked by bad loans, what is known as subprime loans in the United States in 2007-2008. 4. Many banks in the United States, driven by the profits motive, made massive loans to borrowers during the subprime years to those who did not have the ability to pay back or even service the monthly loan on loans. 5. These borrowers were not able to pay back their loans, causing many banks to take on bad loans, leading to the financial system in US and ultimately the world to suffer a global recession. 6. However, those who permitted the subprime loans, despite know that many borrowers are not able to service the loan and who caused the meltdown of the financial system, were not punished. Responses to asymmetric information. Private responses. 1. Screening is seen as one solution to the problems that occur as a result of adverse selection. Screening occurs when the less informed party can find a way to get the other party to reveal the relevant information. 2. In the case of health insurance, it is the insurance companies are the less informed party to get the customer to reveal the information concerning. 3. Risk factors by asking questions concerning, for example, age, weight, whether the consumers smoke, how much alcohol they drink, how active they are, and if they have pre-existing conditions. 4. From this information they can then offer different insurance plans, according to the risk factors. The principle is that higher risk people shall pay higher prices so that insurance companies can sell lower priced insurance policies to people when they know face over risks. Signaling. 1. When the seller has better information than the consumer, signaling is seen as a possible solution. Signaling takes place when the party with more information can provide reliable information to the party with less information. For example, a sued car dealer can provide accurate signals to consumer about the quality of a used car, like giving a warranty to used car buyers that they will make good on any reasonable within 1 year of purchase of the car. This will give the buyer confidence that the car is worth buying. 2. From this information they can then offer different insurance plans, according to the risk factors. The principle is that higher risk people shall pay higher prices so that insurance companies can sell lower priced insurance policies to people when they know face over risks. Government responses, legislation and regulation, provision of information. 1. Governments have a role to play in the transactions between seller and buyers, setting regulations to ensure that the insurance companies do not violate the rights of the consumers. In the job market, potential employees seek to sell their services to employers for some wage or price. 2. Generally, employers are willing to pay higher wages to employ better workers. While the individual may know his or her own level of ability, the hiring firm is not, usually, able to observe such an intangible trait. Thus there is an asymmetry of information between the two parties. Consumer nudges, HL only. 1. Nudge theory refers to the deliberate manipulation of how choices are presented to consumers. Its goal is to influence what consumers choose, to influence them toward making choices that the consumer believes are good for them, or simply to stimulate purchases and increase sales. 2. An example of a nudge is the etching of the image of a housefly into the men's room urinals at Amsterdam's Schiphol airport, which is intended to improve the aim, so that the urinals will require less cleaning up and a public toilet can be more hygienic. Please click subscribe to our video if you find the content useful. All the best with your assignments.